Okay, so learning objective 4.3, evaluate internal controls over cash receipts and cash payments. We're going to take specific areas and look at them and look at how internal controls can be used as it relates to those areas. So cash receipts and cash payments. Cash receipts, cash requires specific internal controls because it is easy to steal and convert to other forms of wealth. In fact, that's probably our biggest risk in most cases. So what you'll see is that, especially like for retailers, they'll have point of sale terminals, and those point of sale terminals provide control over cash receipts. They keep track of how much money that you should be putting into the terminal, so that you can compare that at the end of the hour, the end of the shift, the end of the day, and make sure that what was entered into the sale was in fact received in cash. It also helps to ensure that you record the sales accurately, that you record the cost of items sold accurately, and you reduce inventory accurately. So if you effective for internal control. So these points, I mean, if you can think about those scanners that you have at the exits of Target, Walmart, those point of sale terminals update not only sales, but they update your inventory records. Another control when we're talking about over-the-counter type transactions or cash receipts over the counter, customer issued a receipt as a proof of purchase. So you want to make sure that you have a policy in place where the customer actually obtains a receipt. The point being, why would that be an issue? Well, if you don't have that policy in play, then a recipient can take money in, give you the product, and never even bring it into the register and walk away with that money. A sales associate turns in cash drawer at the end of the shift. If any of you have ever worked for any kind of establishment where they collect cash, you're going to have a drawer, and at the end of the shift, you turn it in. Where I used to work back in the day, we would be responsible for counting our drawers well. I'm not sure how it's done today. And then the accounting department reconciles sales per terminal to the cash drawer. Okay, so then in this example here, there's a third party involved. The accounting department reconciles sales per terminal to the cash drawer, so the accounting department will actually count it out. And I'm a little bit concerned about that if I work, because what if one of the accounting people decide they're going to siphon in a few dollars and make it appear as if I'm the one that's a problem. So that's kind of interesting that that's the case. But another example of cash receipts, control systems or procedures. Typically, you're going to have a mail room that receives all the mail. They're going to go ahead and take in that mail batch, there's going to be some checks. And so those checks are going to be separated, and then there's going to be a remittance advice that's going to be written up. So immediately, once those checks are identified, they're then logged into some type of a receipt program, or likely a program. And then the checks then go to the treasurer, who then creates a deposit ticket, who then deposits that money into the bank. The remittance advices are then given to the accounting department. The accounting department applies those receipts to customers or to wherever it needs to go to. And then they also record simultaneously what goes into cash. And then the cash that's been deposited, and then the bank statement that's been received by the controller, that process then allows for a reconciliation that we're going to be learning about shortly. So the point here is that we're making it a double check system where the physical money goes one way and the evidence of that physical check goes another way. And then at some point in time, we have to have on the back end somebody come in and compare those two to make sure that everything came through the way it was supposed to. Controlling payments by check. Accountants still today actually prefer, for control purposes, making payments by check. Companies make most payments by check or EFT. This is an important internal control because it provides a record of the payment. It must be signed by authorized officials, and payment supported by evidence. So we're ultimately looking to make sure that the organization, the company, keeps in play the evidence the authorization, and the record, that they all are in sync with one another. Now, one of the controls we like to use, or as an example of controls that are used for purchase and payment, we will often split up the following duties. The purchasing of goods. In other words, a purchasing agent or manager actually purchases the goods. The receipt of goods, well, that's done by somebody else. That's in the shipping and receiving department. So purchasing, one individual, receiving, another individual. The payment is then prepared by a third individual, who will then take the information from purchasing and the receiving department, match it all up, and then prepare the check. And then finally, a fourth person is involved for the approval of the payment. Sometimes that's the signature of a check or the electronic funds transfer. Another visual here to show you how it would all work. We have Green Valley Coffee Company and Cisco Foods. So Green Valley Company is going to purchase product or inventory from Cisco Foods. By doing so, they first issue a purchase order. This purchase order authorizes the purchase, and that's forwarded to Cisco Foods. Cisco Foods then sends the product over as inventory, sends the product over to Green Valley. Green Valley receives the inventory. Simultaneously and independently, Cisco Foods sends an invoice to Green Valley Coffee Company. And so now Green Valley Company receives the goods, you have record of the receipt, and then they receive an invoice. Now, the record of receipt is going to come through what's referred to as a receiving report. So now the accounting department has a receiving report, they have a purchase order, they have an invoice, and they're matching it all up to make sure that everything agrees. And when it does, they're going to turn around and issue the payment after acquiring proper authorizations. They then send the payment to Cisco Foods. So we have a purchase order, invoice, and receiving report. All three then are put together, matched up, making sure that the items listed, the quantities listed, the unit prices listed, all of those are consistent between the three reports. Moving on to petty cash. The reason why we're going to talk about petty cash is because it serves as a pretty big risk. I mean, you want to make sure, we'll talk about some of the internal controls in play, but it is a pretty big risk. So we want to make sure we have good internal controls as it relates specifically to petty cash. Now, petty cash is used to pay for minor expenses. Let's emphasize minor. We open the petty cash with a particular amount of cash. It used to be back in the day, $100. Maybe the policy now is more like $500, and I'm sure there's a lot of companies that have a petty cash fund of up to $1,000. Now you're going to identify a custodian of the petty cash. That's kind of like the one responsible for the petty cash, and they're going to prepare a petty cash voucher list, all right? And so as they're issuing out the money to those who are requesting petty cash, the custodian keeps a list of who they're giving the money to and for how much and what the purpose is. And so they started off with, let's say, $500, and now they've been issuing it out to certain individuals. They're keeping track of it, what it's for, the amounts. And now at some point in time, if they started off with $500 and they're only down to, let's say, $20, now they have to turn around and submit the cash voucher list to accounts payable so that they can be reimbursed, so that the petty cash fund can be reimbursed for what has been used. So we call that an Imprest system. The sum of funds plus the vouchers paid should equal the specified balance. So as an example, let's go to the example where I told you that they were down to $20. So if they were down to $20, whether I said $20 before, let's just assume they're down to $20. If they had a $500 petty cash fund and they add up the cash, they have $20. then what they should have is $480 of receipts. So the $480 of receipts plus the $20 of cash sum up to $500. And that makes it so that they're keeping track. So the sum of funds plus the vouchers paid should be it should equal the specified balance. And then we can use debit cards for petty cash as well. But when we do that again from an account that maybe has limited amounts of funds. So you give, let's say you give a debit card to a specific individual that only gets a $500 maximum amount, and that's how they'll keep track of it. There are limitations associated with internal controls, and that's the cost benefit. We talked a little bit about that earlier. You're not going to spend $1,000. You're not going to spend $1 million on an internal control system that's going to protect $1,000 worth of jewelry. The cost and benefit don't make sense. So anytime we're talking about internal controls, we can't lose sight of it. We can't make it so that whatever the internal control system is in place, it either costs directly or it costs indirectly in terms of time and inefficiencies, such that it doesn't make any sense. But we always know that there's going to be some inherent limitations. And so some examples of internal controls or ways to circumvent internal controls is collusion. Two or more people working together, and those two people. So for example, even if we separate responsibilities, for example, let's go back to the purchasing and the receipt department. If you have a receiving individual of the goods and the purchasing individual in the purchasing department working together to purchase goods and then take those goods and pull them off to the side so that now they can enjoy those goods, whatever they are, or sell them themselves, then that's an example of collusion where two or more people work together to defeat an internal control system. You can't have management override, and what you have to be conscious about is that there are times when it makes sense for management to step in and say, no, we can't do it this way. We're going to have to circumvent the system to make sure we can fulfill our obligations. But just by nature of having that ability for management override creates a limitation. And then there are human limitations, including fatigue and negligence. The benefit of internal controls should always outweigh the costs. Benefits should always outweigh the costs, or the costs should never exceed the benefits.